Before we dive in, please remember that I am not a CPA, tax attorney, or financial advisor. This video is for informational and educational purposes only. Tax laws are incredibly complex and can change, and your personal financial situation is unique. This presentation should not be taken as legal or financial advice. Please, always consult with a qualified professional before making any financial decisions. Alright, let's talk about the single biggest check you write every month. That mortgage payment. You see it leave your account on the first of the month every month like clockwork. And for most of us, it feels like we're just lighting money on fire. It's the cost of having a roof over our heads, right? But what if I told you that inside that one giant payment, there is a hidden treasure chest of tax savings? What if that mortgage statement you dread looking at is actually a roadmap to getting thousands of dollars back from the IRS? The shocking truth is, the US government wants you to own a home. They've baked a series of powerful incentives, loopholes, and deductions right into the tax code specifically for homeowners. But here's the catch. They don't advertise them. They don't send you a friendly reminder. The IRS is not going to call you up and say, "Hey, you forgot to claim an extra $2,000. It is 100% up to you to find them, to claim them, and to keep your own hard-earned money. And that's where the problem starts. The tax code is over 70,000 pages long. It's confusing, it's intimidating, and let's be honest, it's boring. So what do most people do? They plug a few numbers into a tax software, cross their fingers, and hope for the best. They check the box for mortgage interest, and assume that's the end of the story. They are leaving a staggering amount of money on the table. We're talking about an average of over $1,000 per homeowner per year. For some, it's $5,000, even $10,000. That's a vacation. That's a kitchen upgrade. That's a huge chunk of your emergency fund. And it's your money. So in this video, we are going to change that. Right here, right now. We are going on a mission to uncover every single significant mortgage-related tax deduction available to you as a US homeowner this year. No confusing jargon. No 70,000-page rulebooks. Just a simple, straightforward guide to slashing your tax bill and maximizing your refund. By the end of this presentation, you will know more about these deductions than 99% of homeowners out there. You will be able to confidently identify what you can and cannot claim, and you will have a clear action plan to ensure you never overpay the IRS again. We've spent hundreds of hours combing through IRS publications, consulting with tax experts, and simplifying this complex information so you don't have to. We're going to give you the exact knowledge you need to either file your own taxes with ironclad confidence, or to walk into your accountant's office and have an intelligent conversation, making sure they don't miss a single thing on your behalf. And we're going way beyond the basics. Yes, of course, we're going to cover the 800-pound gorilla in the room, the mortgage interest deduction. We'll break down exactly how it works, the current limits you absolutely need to know, and the common mistakes that get people in trouble. But that's just the appetizer. That's lesson 101. We're going to get you a PhD. After that, we're going to expose the secrets of deducting points. Did you pay points to lower your interest rate when you bought your house or refinanced? Most people don't realize you can often deduct the entire cost, but the rules are incredibly tricky, and if you get it wrong, it can trigger an audit. We'll show you how to get it right. Then we'll talk about private mortgage insurance, or PMI. That extra fee you pay every month when you have a smaller down payment? For a long time you couldn't deduct it. Then you could. Then the deduction expired. Well, it's back, and it's one of the most commonly missed deductions out there. We'll tell you exactly who qualifies and how to claim it. From there, we're going to dive deep into the world of home equity loans and lines of credit, or HELOCs. The rules for deducting interest on these have changed dramatically in recent years, and frankly, most homeowners are completely in the dark about what's allowed. Using that money for a vacation versus a home renovation can mean the difference between a massive deduction and absolutely nothing. Getting this wrong is like throwing money away. We'll make it crystal clear for you. We will also cover deductions for your property taxes, which, while not technically a mortgage deduction, are tied directly to your homeownership and are almost always paid through your mortgage escrow account, making them part of that big monthly payment. The state and local tax cap, or SALT cap, has made this a hot-button issue, and you need to understand precisely how it impacts your bottom line. And finally, for those of you with side hustles or who work from home, we'll touch on the powerful home office deduction, which allows you to write off a portion of all your housing expenses. And we'll even cover some of the lucrative tax credits available for making energy-efficient home improvements. These are the niche deductions that can add up to thousands, but are so often missed because they aren't on the front page of your tax software. Look, your home is the biggest investment you will ever make. It's time to make sure that investment is working for you, not just on paper with rising equity, but in the real world on your tax return every single year. The information we're about to share isn't just theory. It's actionable strategy. It's the difference between getting a standard, maybe disappointing refund and getting a wow, what am I going to do with all this kind of refund. It's about transforming that dreaded mortgage payment from a pure expense into a powerful financial tool. You've worked too hard for your money to just give it away because of confusion or a lack of knowledge. The system is designed to reward homeowners, but only the ones who know the rules of the game. Today you're going to learn the rules. So grab a notepad, turn off the distractions, because we are about to start with the single biggest tax break available to homeowners. The one that forms the foundation of all your savings. The one you think you know but probably don't. Let's break down the mortgage interest deduction, and let's start getting your money back. Alright, let's pull back the curtain on this giant of the tax world. The mortgage interest deduction is based on a simple, powerful idea from the government. Hey, you took a huge financial risk to buy a piece of the American dream. As a thank you, and to encourage you to keep doing it, we're going to let you subtract the interest you pay on your loan from your taxable income. Think about that. If you're in the 22% tax bracket, every dollar of interest you deduct is like getting 22 cents back in your pocket. It's a direct discount on your tax bill, courtesy of your house keys. But, and this is where everyone gets tripped up, it's not a free-for-all. The IRS puts a velvet rope around this exclusive club. The first rule, the big one that changed everything a few years back, is the debt limit. You can only deduct the interest on a total of $750,000 of mortgage debt. If you're married but filing separately, that number gets sliced in half to $375,000. Let me be crystal clear about what this means because the wording is tricky. This is a limit on the loan amount, not the value of your home, and not the amount of interest you can deduct. Your house could be worth $3 million, but if your mortgage is $750,000 or less, you can deduct 100% of the interest you pay. But let's say you bought a place in a pricier market and your mortgage is $1 million. You don't get to deduct all the interest. You only get to deduct the interest on the first $750,000 of that loan. Essentially, the IRS pretends that last $250,000 of your loan doesn't exist for tax purposes. Now, for those of you who have been in your homes for a while, there's a little time travel exception. If you took out your mortgage before December 16, 2017, you get to play by the old rules. You are grandfathered in. For you, the limit isn't $750,000, it's a cool $1 million, or $500,000 if married filing separately. This is a huge advantage that the Tax Cuts and Jobs Act preserved for existing homeowners. So if you're sitting on a mortgage from 2016, congratulations, you're in a more exclusive VIP section of this tax club. So that's the how much. The next question is, on what? The IRS calls it qualified debt, which means the money had to be used to buy, build, or substantially improve your home. You can't just take out a huge home equity loan to buy a Lamborghini and deduct the interest. The debt has to be secured by your home, and it has to be for the home itself. And here's a fantastic little kicker most people miss. This deduction isn't just for your main house. It applies to your primary residence and one other secondary home. That's right. That lake cabin you escaped to on the weekends? The condo you bought near the beach? As long as you use it personally for a certain amount of time each year, the mortgage interest on that second property is also potentially deductible, all under that same $750,000 total debt umbrella. And the IRS has a surprisingly broad definition of a home. It just needs to have sleeping, cooking, and toilet facilities. So, in theory, the loan on your boat or your RV could qualify if you're using it as that second home. Imagine deducting the interest on your land yacht. Okay, so you know the limits, you know which properties qualify. How do you actually do it? This is the easy part. Your lender does all the heavy lifting for you. Every January, they are legally required to mail or electronically send you a magical piece of paper. IRS Form 1098, the mortgage interest statement. This form is your golden ticket. It breaks down everything you paid them last year. But you only need to look for one number. The amount in box 1. That box, labeled mortgage interest received from payer/borrower, is the number. That's the figure you'll use when you file your taxes. It's that simple. Your bank does the math, you just copy the number. So to recap, we have a massive potential deduction. We know the debt limits which homes qualify, and exactly where to find the number on the form our bank sends us. At this point, you're probably thinking, Great! I paid $20,000 in interest last year. My loan is under the limit. I'm going to save a ton of money. And this is where we have to have a serious talk. This is the single most important point in this entire video, the one that separates the people who think they're saving money from the people who actually are. Everything we've just discussed, the $750,000 limit, the Form 1098, all of it only matters if you choose to itemize your deductions. Let me say that again. You only get to take the mortgage interest deduction if you itemize. What does that mean? The U.S. tax system gives you a choice. You can either take the easy route and accept the standard deduction, a fixed dollar amount that the government lets you subtract from your income, no questions asked. For 2024, that amount is $14,600 for a single person and a whopping $29,200 for a married couple filing jointly. It's a generous, simple, one-size-fits-all haircut for your taxable income. Or you can choose to itemize. This is the hard route. This means you reject the standard deduction and instead add up all your individual, specific deductible expenses one by one. This includes things like your state and local taxes, charitable donations, certain medical expenses, and, of course, your mortgage interest. You only benefit from itemizing if your grand total of all those individual deductions is greater than the standard deduction you could have taken instead. This is the great filter. The standard deduction is now so high that for millions of American homeowners, it's no longer worth it to itemize. They actually save more money by just taking the standard deduction and ignoring their mortgage interest completely. Let's run the numbers with a quick example. Meet Mike and Jessica. They're married, they bought a home, and they're excited for their first tax season as homeowners. They get their Form 1098 and see they paid $18,000 in mortgage interest. Fantastic! They also look up their property tax records and see they paid $7,000 in state and local taxes, often called SALT. And they're generous people, so they donated $1,000 to their favorite charity. Let's add it up. They have $18,000 in mortgage interest, plus $7,000 in SALT, plus $1,000 in charity. Their total itemized deductions are $26,000. Now let's look at the other option. As a married couple, their standard deduction is $29,200. So they have a choice. Deduct $26,000 by itemizing, or deduct $29,200 by taking the standard. The choice is obvious. They are more than $3,000 better off forgetting about their mortgage interest and just taking the standard deduction. Even though they paid all that interest, it gives them zero tax benefit in this scenario. This is the reality check. The mortgage interest deduction isn't a standalone credit you just get. It's a foundational piece of a much larger puzzle. For many, it's the single biggest piece, the one that does the most work to get you over that standard deduction finish line. But it rarely does it alone. You need to see it as the engine of your itemization train. It provides most of the power, but you still need to attach other cars, other deductions, to make the journey worthwhile. So the critical question you have to ask yourself isn't, how much interest did I pay? The real question is, how much interest did I pay? And what other deductions can I find to stack on top of it to make my total bigger than the standard deduction? That's where the real savings are unlocked. And that's exactly what we're going to cover next. Because sitting right next to your mortgage interest is another powerful home-related deduction. One that, when combined with your interest, can easily push you over the top. We're talking about your property taxes. And for good reason. For decades, property taxes were one of the most straightforward and powerful deductions available to homeowners. You paid them, you deducted them. Simple. If your property taxes were $20,000, you got to deduct $20,000 from your income. This single deduction was often enough to make itemizing a no-brainer for millions of Americans, especially those living in states with high property values. But then everything changed. In 2017, the tax code underwent its most significant overhaul in over 30 years. And buried deep inside this massive law was a single provision that sent a shockwave through the housing market and completely rewrote the rules for homeowners. It's called the SALT deduction cap. And if you own a home in the United States, understanding these four letters, S-A-L-T, is no longer optional. It is absolutely critical to your financial health. SALT stands for state and local taxes. Think of it as a bucket. The IRS gives you this one bucket, and you can put certain state and local taxes you've paid into it. What goes in the bucket? First, your property taxes, the very thing we're talking about. Every dollar you pay in real estate taxes to your city, county, or school district goes into this bucket. But that's not all. You also get to add one of two other things. Either your state and local income taxes or your state and local sales taxes. You have to choose one. For most people who earn a regular salary, their state income tax is going to be a much larger number than their sales tax, so that's what goes in the bucket alongside their property tax. So, you've got your property taxes in the bucket. You've added your state income taxes. You've got a big total. Now here comes the gut punch. Before 2018, the amount you could deduct from this bucket was unlimited. If you had $50,000 in state and local taxes, you could deduct $50,000. But the new law placed a hard, immovable cap on that bucket. The total amount of state and local taxes you can now deduct is $10,000. That's it. $10,000 per household, not per person. So if you're married and filing jointly, your cap is $10,000. If you're single, your cap is $10,000. The only exception is if you're married and filing separately, in which case the cap is $5,000 each. Let's let that sink in for a moment. This single change effectively neutralized one of the biggest tax benefits of homeownership for a huge portion of the country. To see the impact, let's imagine two homeowners. First, there's Sarah in Dallas, Texas. Texas has no state income tax, but it does have relatively high property taxes. Let's say Sarah pays $9,000 a year in property taxes. She can put that $9,000 in her SALT bucket. Since she has no state income tax, she might choose to add her state sales taxes. Maybe she can track another $1,000 in sales tax from her purchases throughout the year. Her total in the bucket is $10,000. She gets to deduct the full amount. For Sarah, the SALT cap isn't really a huge deal. Now let's look at David and Jessica in Bergen County, New Jersey. They have a combined income and pay about $8,000 in state income tax. Their property taxes on their modest suburban home are a staggering $16,000 per year. So what goes in their SALT bucket? Their $16,000 in property taxes plus their $8,000 in state income taxes. That's a grand total of $24,000 in state and local taxes they paid during the year. But how much can they deduct? Only $10,000. The other $14,000, poof. It vanishes as a federal tax deduction. They still had to pay it, of course, but they get absolutely no federal tax benefit for it beyond that $10,000 limit. You can see how this fundamentally alters the math of homeownership in states like New Jersey, New York, California, Illinois, and Connecticut. What was once a major financial incentive to own a home has been severely curtailed. So, the first thing you need to do is figure out if this cap even affects you. You need to do the SALT bucket math. First, find out how much property tax you paid. The easiest place to find this is on the Form 1098 your mortgage lender sends you in January. It's the same form that shows your mortgage interest. There will be a box, usually box 10, that shows the amount of real estate taxes paid from your escrow account. This is the number the IRS sees, so it's your starting point. Next, figure out your state and local income tax. Look at the W-2 forms from your employers. There will be a box that shows the total amount of state income tax that was withheld from your paychecks all year. Add it up. Now, add your property tax number and your state income tax number together. Is that total over $10,000? If it is, you are being impacted by the SALT cap. You can only deduct $10,000 even if you paid more. If the number is under $10,000, congratulations, you can deduct the full amount you paid. Now, a quick but important side note on choosing between income and sales tax. As I said, for most people, income tax is the bigger number. But what if you live in one of the states with no income tax, like Florida, Texas, Washington, or Nevada? In that case, you'll definitely want to deduct your sales taxes instead. The IRS even provides a calculator and tables to help you estimate a standard amount based on your income and location, so you don't have to save every single receipt. But if you made a major purchase during the year like a car, a boat, or an RV, you can add the sales tax from that specific purchase on top of the standard table amount. This is a pro tip that can add thousands to your deduction if you live in a no-income tax state. Because the SALT cap is so restrictive, it's led homeowners to ask a very clever question. If I'm capped at $10,000 this year, can I prepay next year's property taxes in December to get the deduction now, before I pay my state income tax next year? It's a smart idea, trying to manage the timing of when things go into the bucket. Unfortunately, the IRS is way ahead of you on this one. The rule is very specific. You can only deduct property taxes in the year that they are both paid and assessed. Assessed is the key word. Your local government has to have officially billed you for those taxes. You can't just prepay a random amount for a future tax year that hasn't even been calculated yet, and expect to deduct it. So, if your town assesses your 2025 property taxes in late 2024, and you pay them in December 2024, you can deduct them on your 2024 return. But you can't just send your town a check in December for what you think next year's taxes will be, and claim it. It doesn't work. The SALT cap is, without a doubt, one of the most controversial and impactful tax changes for homeowners in modern history. It redrew the financial map, creating a massive divide between homeowners in high-tax and low-tax states. It forces you to be more strategic. You have to understand that your property tax deduction doesn't live on an island. It's part of a package deal bundled with your state taxes, and that whole package is capped. Knowing this is half the battle, because now you know the ceiling. You know that no matter how high your property taxes are, their contribution to your federal tax return is limited. This is a foundational piece of the puzzle. You have your mortgage interest, which for many is still a huge number. And now you have your state and local taxes capped at $10,000. Together, these two deductions form the bedrock of itemizing for homeowners. But they're not the only pieces. There's another, often overlooked, cost you paid when you first bought your home or refinanced your mortgage. It's that chunk of money you paid up front just to secure the loan itself. Those thousands of dollars you paid in what the bank called points. That wasn't just a fee you had to swallow. It was a prepayment of interest. And the IRS lets you deduct it. But the rules for how and when you can deduct it are incredibly specific, and getting them wrong can cost you thousands. That's exactly what we're breaking down next. So let's talk about mortgage points, also known as discount points. The IRS gives you two potential ways to handle them. You can either deduct the full amount in the year you paid them, which is a massive win, or you have to spread that deduction out over the entire life of your loan. Obviously, we all want that big, juicy deduction right now. To get it, you have to pass a very specific 9-part test from the IRS. It sounds intimidating, but we're going to walk through it step by step. And for most standard home purchases, you'll pass with flying colors. Let's call this the all-at-once deduction test. Test number 1. Your loan must be secured by your main home. This means the house you live in most of the time. This deduction isn't for your vacation cabin or that rental property you own across town. It has to be your primary residence. Simple enough. Test number 2. Paying points must be an established business practice in the area where the loan was made. This sounds weird and vague, but it's basically the IRS's way of making sure this is a legitimate standard charge. And let's be honest, in virtually every market in the United States, paying points is a completely normal part of the mortgage process. You don't really need to worry about this one. Test number 3. The points paid were not more than the amount generally charged in that area. This ties into the last point. If most people are paying 1 or 2 points and you pay 10, the IRS might raise an eyebrow. As long as your points are within the normal range your lender offers, you're fine. Test number 4. You use the cash method of accounting. This is another one that sounds complex but is actually incredibly simple. Unless you're a C corporation or a complex business, you use the cash method. It just means you report income in the year you receive it and deduct expenses in the year you pay them. Over 99% of individual taxpayers use this method. So check that box. Test number 5. The points were not paid in place of amounts that are ordinarily stated separately on the settlement statement. Things like appraisal fees, inspection fees, title fees, attorney fees, or property taxes. Basically, the lender can't just lump a bunch of random closing costs together, call them points, and let you deduct them. The points have to be a pure and simple prepayment of interest. Your closing disclosure statement will have this broken down clearly. Okay, those first 5 are pretty easy. Now we get to the most important one. The one that trips people up more than any other. Test number 6. The funds you provided at or before closing, plus any points the seller paid, were at least as much as the points charged. This is the IRS's skin in the game rule. They want to see that you paid for these points with your own money, not with borrowed funds from the lender. Let me break this down. Imagine you're buying a $400,000 house and your loan is for $350,000. You decide to pay 1 point to lower your interest rate. 1 point is 1% of the loan amount, so that's $3,500. To pass this test, you need to prove you brought at least $3,500 of your own cash to the table at or before closing. What counts as your own cash? Your down payment, for one. Any earnest money you put down when you made the offer. Any other cash deposits or payments you made as part of the closing process. So if your total down payment was $50,000, you've clearly brought more than the $3,500 needed to cover the points. You easily pass this test. But what if you were getting a zero-down loan like a VA loan or a USDA loan? Let's say you paid $3,500 in points, but you didn't have a down payment. In this case, the points would be rolled into the loan amount. You'd be borrowing the money to pay the points. And because you didn't pay for them with your own separate funds, you would fail this test. It doesn't mean you lose the deduction, and this is critical, it just means you can't take it all at once. We'll cover what to do in that situation in just a minute. Moving on. Test number 7. You use your loan to buy or build your main home. This is a bit of a repeat of rule number 1, but it's an important distinction. The full, immediate deduction for points is designed for purchase mortgages, not for refinancing. Test number 8. The points were computed as a percentage of the principal amount of the mortgage. This is just the definition of what a point is. Again, your closing documents will show this clearly. And finally, test number 9. The amount is clearly shown on your settlement statement, either the settlement statement HUD-1 or the closing disclosure. It must be specifically listed as points or loan origination fee. If it's called an application fee or something else, it doesn't count. The IRS wants to see the magic word, points. So, if you bought your main home this year and you can say yes to all 9 of those conditions, congratulations. You can deduct the entire amount you paid for points on this year's tax return. For many people, that's a deduction of thousands of dollars. But what if you failed one of those tests? What if you refinanced your mortgage? Or what if you bought a second home? Or what if you didn't bring enough cash to closing to cover the points? Do you lose the deduction forever? Absolutely not. You simply have to deduct it differently. Instead of taking it all in 1 year, you have to spread the deduction out evenly over the life of the loan. This is called amortization. Let's look at the most common scenario. Refinancing. Millions of Americans refinance their homes. Let's say you paid $4,000 in points to refinance into a new 30-year mortgage. Because this isn't a loan to buy or build a home, you failed test number 7. Therefore, you must amortize the deduction. Here's how the math works. A 30-year loan has 360 monthly payments. You take the total points you paid for $1,000 and divide it by the total number of months in the loan, 360. That comes out to about $11.11 per month. That is your monthly points deduction. Now, you multiply that amount by the number of mortgage payments you made that year. If you refinanced in January and made all 12 payments, you can deduct 12 times $11.11, which is about $133 for the year. If you refinanced in October, you only made 3 payments, October, November, December, so you could deduct 3 times $11.11, which is about $33. You would then continue deducting about $133 each full year for the next 29 years. The same exact rule applies if you take out a home improvement loan and pay points on it, or if you buy a second home or an investment property and pay points. In all those cases, you have to spread the deduction over the life of the loan. But now for the really cool part. The question that can save you a fortune. What happens if you amortizing your points and then you sell the house or pay off the loan early? Do you just lose out on the rest of that deduction? No. And this is a hugely overlooked tax benefit. In the year you pay off the loan, either by selling the house or refinancing again, you get to deduct the entire remaining undeducted balance of the points all at once. Let's go back to our refinancing example. You paid $4,000 in points. After 5 years of deducting about $133 per year, you've deducted a total of $665. You still have $3,335 of undeducted points remaining. In year 6, you decide to sell the house. On that year's tax return, you get to take a lump sum deduction for the full remaining $3,335. That is a massive tax savings that many people completely forget about. It's your money. The IRS says you can claim it. One final, quick note on seller-paid points. Sometimes, as part of the negotiation, a seller will agree to pay for some of your points to help you secure a better interest rate. This is great news. The IRS actually treats these points as if you paid them yourself. So you, the buyer, get to take the tax deduction. The only catch is that you must subtract the amount of the seller-paid points from the cost basis of your home. So if you bought the house for $500,000 and the seller paid $5,000 in points for you, your new cost basis for tax purposes is $495,000. This will affect your capital gains calculation when you eventually sell, but in the meantime, you get the immediate tax deduction, which is a fantastic deal. So we've covered the 2 giants of mortgage deductions: mortgage interest and mortgage points. They represent the bulk of the tax benefits you get from your loan. But there's a third, often temporary, but incredibly important deduction related to your mortgage payment that vanished for a while and then came roaring back. For hundreds of thousands of homeowners, it's worth hundreds, if not thousands of dollars a year. I'm talking about private mortgage insurance, or PMI. And the rules surrounding its deductibility are something every new homeowner needs to understand. So let's pull the curtain back on this thing called PMI. For millions of first-time homebuyers who couldn't quite scrape together that traditional 20% down payment, PMI is the uninvited guest at the housewarming party that you have to pay for. In simple terms, private mortgage insurance doesn't protect you. It protects the lender. The bank looks at a loan with less than 20% equity and sees a higher risk of default. So, they force you to buy an insurance policy that pays them if you stop paying your mortgage. It's like the bank is making you pay for their seatbelt because they think you're a risky driver. Feels a little unfair, and for years the government seemed to agree. They allowed homeowners to deduct the cost of these PMI premiums right on their tax returns, just like mortgage interest. It was a huge relief, turning a frustrating monthly expense into a valuable end-of-year tax break. But here's where the story gets messy, and why you absolutely need to pay attention. The PMI deduction has had one of the most turbulent histories of any tax break in the code. It has been a political football, kicked back and forth in Washington for over a decade. It was first introduced, then it expired. Congress would wait until the last possible second, sometimes even after the tax year had ended, and then retroactively extend it for another year or two. It was a constant source of anxiety and confusion for taxpayers and tax professionals alike. You'd go through an entire year not knowing if that $1,000, $2,000, or even $3,000 you paid in PMI would be deductible. Then, in late December, a massive spending bill would get passed, and tucked away on page 1872 would be a little sentence extending the PMI deduction for one more year. This cycle of last-minute reprieves came to a screeching halt. The Tax Cuts and Jobs Act of 2017 initially killed the deduction. Then it was brought back. Then the Consolidated Appropriations Act extended it through the end of 2021. And then silence. For the 2022 tax year, it was gone. For the 2023 tax year, it was gone. And as we look at the tax code for this year, it is still gone. The deduction for private mortgage insurance premiums has expired, and Congress has not renewed it. Now I know what you're thinking. Did I just listen to all of this for you to tell me the deduction doesn't exist anymore? And the answer is no, because this is where the real value lies. Understanding this history is not just a trivia lesson. It's a potential key to unlocking money you might be owed and a critical roadmap for the future. First, let's talk about the past. The IRS generally gives you a 3-year window from the date you filed your original return to make changes and claim a refund. This is called filing an amended return. Think about it. The last full year the PMI deduction was available was 2021. If you filed your 2021 taxes on time in April of 2022, you have until April of 2025 to amend that return. Did you buy a house in 2020 or 2021? Did you have PMI? Did you take the standard deduction that year? But maybe, just maybe, if you had added your PMI premiums to your mortgage interest and property taxes, it would have pushed you over the edge to itemize. It is absolutely worth going back and looking at your old tax returns and your old Form 1098 from your mortgage lender. You could be leaving hundreds of dollars on the table from a tax break that was rightfully yours. Second, let's talk about the future. Just because this deduction is dead now doesn't mean it will stay dead forever. As I said, it's a political football. It's a popular provision, especially with first-time homebuyers, and there is always pressure on lawmakers to bring it back. If and when they do, they will almost certainly bring it back with the same rules and limitations it had before. By understanding those rules now, you will be prepared to take immediate advantage of it the moment it's resurrected, while everyone else is scrambling to figure it out. So what were those rules? Think of this as your playbook for when the game is back on. The first and most important rule was the income limitation. This was not a tax break for the wealthy. The deduction began to phase out once your adjusted gross income, or AGI, hit $100,000 for most filers, or $50,000 if you were married filing separately. For every $1,000 you earned over that $100,000 threshold, your PMI deduction was reduced by 10%. By the time your AGI reached $109,000, the deduction was completely gone. So, if this deduction comes back, the very first thing you need to check is your AGI. If you're a high-income earner, this particular tax break likely won't apply to you anyway. The second rule is that it was an itemized deduction. This is a theme we keep coming back to. You had to choose to itemize your deductions on Schedule A. instead of taking the standard deduction. For the PMI deduction to be of any use to you, the total of all your itemized deductions, your mortgage interest, your state and local taxes, your charitable contributions, and your PMI premiums, had to be greater than the standard deduction for that year. For many new homeowners, adding in a couple $1,000s of PMI premiums was the exact thing that made itemizing worthwhile. And finally, you had to know where to find the number. Your lender reports the amount of mortgage insurance premiums you paid for the year in Box 5 of your Form 1098, the mortgage interest statement. It's the same form that shows your mortgage interest in Box 1. So, even though the deduction isn't active right now, get in the habit of looking at Box 5 on your 1098 each year. If you see a number there, file it away. It might be worthless this year, but it could be gold next year. So the PMI deduction is a ghost of tax past, but one that could come back to haunt the tax code in a good way. But let's be brutally practical. Hoping for a change in tax law is not a financial strategy. The real winning move isn't deducting your PMI. It's eliminating it altogether. Your primary financial goal should be to get rid of that extra monthly payment as soon as humanly possible. How do you do that? The magic number is 22%. Or 20%. Let me explain. You can request that your lender cancel your PMI once your loan-to-value ratio reaches 80%. This means you have 20% equity in your home. This can happen in two ways: by paying down your mortgage principal, or by your home's value appreciating. If you live in an area where home prices have shot up, you might already be there. You can contact your lender and request to have it removed, though you'll likely have to pay for a new appraisal to prove the home's current value. But there's also a safety net. The Federal Homeowners Protection Act requires lenders to automatically terminate your PMI on the date when your principal balance is scheduled to reach 78% of the original value of your home. That's assuming you're current on your payments. So you can either be proactive and request it at 80%, or wait for the lender to automatically drop it at 78%. Either way, getting rid of a payment that can be hundreds of dollars a month is a far bigger financial win than a potential tax deduction ever could be. So, the story of the PMI deduction is a cautionary tale. It teaches us that tax breaks can be temporary, that we need to be aware of the past to claim what we're owed, and that the best strategy is to improve our own financial situation, rather than relying on the whims of Washington. But while PMI might be a ghost from tax past, there's another deduction that's very much alive, but it's been handcuffed by the government. It's a deduction every single homeowner pays, but one that millions can no longer fully claim. I'm talking about your property taxes, and the controversial $10,000 limit that has homeowners in high-tax states seeing red. This single rule change has cost some families thousands of dollars a year, and understanding how it works, and the loopholes that might exist, is absolutely essential. So let's break down this beast, this $10,000 wall that stands between you and your hard-earned money. It's officially called the SALT cap. SALT stands for state and local taxes. Think of it as a bucket. Into this bucket you can pour a few different things. First, your property taxes, every single dollar. Then you have a choice to make. You can either pour in your state and local income taxes, or your state and local sales taxes. You can't do both. You pick the one that's higher, which for most people with a job is their income tax. Before 2018, this bucket was bottomless. If you lived in a state like New Jersey and paid $20,000 in property taxes and another $15,000 in state income taxes, you could dump all $35,000 into that bucket and deduct the entire amount from your federal taxable income. It was one of the single most powerful deductions for homeowners in high cost of living areas. It was a financial lifeline. Then, the Tax Cuts and Jobs Act of 2017 came along and put a lid on that bucket. A very, very firm lid. Now, no matter how much you pour in, $30,000, $50,000, even $100,000 in state and local taxes, you can only deduct a maximum of $10,000 per household. That's it. For a married couple filing jointly, it's $10,000. For a single person, it's $10,000. The number doesn't change. Let's put this in real-world terms. Meet Alex and Maria, a couple living in a suburb of Chicago. Their property taxes are $18,000 a year. Their combined state income tax is another $12,000. So their total SALT is $30,000. Before the cap, they could deduct the full $30,000. Assuming they're in the 24% federal tax bracket, that deduction saved them $7,200. Real cash. Now, they can only deduct $10,000. That deduction is now only worth $2,400. The SALT cap in a single year cost them $4,800. It's like their town suddenly sent them a surprise bill for nearly $5,000, and there's nothing they can do about it. Multiply that over the years the law has been in effect, and you're talking about tens of thousands of dollars vanished from their family's budget. This is why people are furious. It feels like a penalty for living in certain parts of the country. So the promise was loopholes. And the internet is filled with so-called gurus, offering clever tricks. The most common one you'll hear is about marital status. The logic goes like this. If the cap is $10,000 per household, maybe a married couple can file their taxes separately. The husband files his own return, the wife files hers. Can they each claim a $10,000 deduction for a total of $20,000? Sounds brilliant. Sounds like you've outsmarted the system. And it is completely, utterly wrong. This is a dangerous piece of misinformation. When a married couple chooses to file separately, the SALT cap is cut in half for each of them. Each spouse can only deduct a maximum of $5,000. So together, their maximum is $10,000. You go through all the hassle and paperwork of filing separately for absolutely zero benefit on the SALT deduction. In fact, you almost certainly make your situation worse. Filing separately disqualifies you from a whole host of other, incredibly valuable tax credits and deductions. You can kiss the Earned Income Tax Credit goodbye. You can forget about the education credits like the American Opportunity Credit. Your ability to deduct student loan interest? Gone. Your ability to contribute to a Roth IRA? Severely limited or eliminated. It is, for 99.9% of couples, a financially disastrous move. So let's put that myth to bed. Filing separately is not a loophole, it's a trap. But there is another way. A real one. It's more complex, it's not for everyone, but for the right person. It's the equivalent of finding a secret passage around that $10,000 wall. It's called the PTT workaround. PTT stands for Pass-Through Entity Tax. Now, stay with me because this is where we get into the weeds, but this is also where the real money is saved. This strategy is designed for business owners. If you're a freelancer, a contractor, a partner in a firm, or you own an S corporation or an LLC, listen very closely. Normally, as a business owner, the profits from your business pass through to your personal tax return. You then pay state income tax on those profits, and that state tax payment gets dumped into your SALT bucket, where it gets stuck under that $10,000 cap. But over 30 states have now enacted PTT laws as a direct response to the SALT cap. Here's how it works in its simplest form. Instead of the profit passing through to you personally first, your business entity itself elects to pay the state income tax on your behalf. Why is this a seismic shift? Because when your business pays a state tax, it's considered an ordinary and necessary business expense. And businesses can deduct their expenses. All of them. There is no $10,000 cap on business expenses. So your business pays the state tax on the profits and deducts that entire payment from its income on your federal tax return. This lowers the amount of profit that eventually passes through to you. Then, on your state tax return, you receive a credit for the exact amount of tax that your business already paid. You're not paying the tax twice. Let's go back to Alex and Maria from Chicago. Let's say Maria is a freelance marketing consultant who runs her business as an S-Corp. Her share of the business profit is $100,000, and her Illinois state income tax on that is about $5,000. Without the workaround, that $5,000 in state tax goes into her SALT bucket along with their $18,000 property tax bill. They're already over the $10,000 cap just from property taxes, so that $5,000 state tax payment gives them zero additional federal tax benefit. It's just a cost. But with the PTT workaround, things change. Maria has her S-Corp elect to pay the $5,000 in Illinois tax directly. The S-Corp then deducts that $5,000 as a business expense on its federal return. This means the profit that passes through to Maria's personal return is now $95,000, not $100,000. If she's in that 24% federal tax bracket, reducing her taxable income by $5,000 saves her $1,200 in federal taxes. Instantly. Then, on her personal Illinois state tax return, she gets a $5,000 credit, wiping out her liability. She has effectively bypassed the SALT cap for her business income. She just clawed back $1,200 from the IRS legally and ethically. Now imagine if Maria's business was more profitable, or if she was a partner in a law firm where her share of the state tax was $30,000 or $40,000. The savings would be astronomical. This isn't a gimmick. It's a state-sanctioned, IRS-acknowledged strategy. It's the most powerful tool available right now to fight back against the SALT cap. Every state's rules are slightly different, and you absolutely need to talk to a qualified tax professional to see if this makes sense for your specific business structure and state. But if you have any sort of pass-through business income, you owe it to yourself to ask the question, should I be making a PDD election? Could be the most profitable question you ask all year. So we've uncovered a powerful, but specific strategy for business owners to slash their tax bill. But that leaves a huge question hanging in the air. What about everyone else? What if you're not a business owner? What if you're just a regular employee who sometimes works from home? For years, the home office deduction was a holy grail of tax savings for homeowners. But a recent change completely wiped it out for millions of W-2 employees. Or did it? The truth about who can still claim this powerful deduction, and the surprising ways it can save you thousands even if you're not self-employed, is not what you think. And it's a story of fine print, exceptions, and a little-known rule that could change everything for you. Let's start with the hard truth, the one that made millions of homeowners sigh in frustration after 2017. The Tax Cuts and Jobs Act, or TCJA, famously took a sledgehammer to one of the most beloved deductions for the modern worker, the home office deduction for employees. Overnight, the ability for regular W-2 employees to deduct the costs of their home office as an unreimbursed employee expense vanished. It was moved into a category of miscellaneous itemized deductions, and then that entire category was suspended. Gone. Poof. So the conventional wisdom became, unless you are a full-blown 1099 filing, self-employed business owner, you cannot claim a home office. End of story. But what if I told you that's not the end of the story? What if that's just the cover, and the real secrets are hidden in the chapters nobody reads? What if the line between employee and business owner is far blurrier than you think, and crossing it, even in a small way, unlocks the very deduction you thought was gone forever? This is where the game changes. Imagine a woman named Chloe. Chloe is a salaried project manager for a big tech company. She works entirely from home, a situation that became permanent after 2020. Her company provides a laptop and a monitor, but that's it. Chloe had to convert her spare bedroom into a fully functional office. She bought the desk, the ergonomic chair, the extra lighting. She pays for faster internet. Her electricity bill is higher. Her home's HVAC system runs all day. She is, in effect, subsidizing her multi-billion-dollar employer's overhead. And at tax time, her accountant tells her the same thing you've heard. Sorry, Chloe. You're a W-2 employee. You can't deduct any of this. Feels deeply unfair because it is. But Chloe has a passion. On the weekends, she does freelance graphic design work. It's not a huge business. She makes maybe $5,000 or $6,000 a year from it, designing logos for small businesses she finds online. She does this work in the very same home office at the very same desk. And right there, in that small side hustle, is the key that unlocks everything. The IRS has two critical tests for a home office to be deductible. These are the gatekeepers. The first is the regular and exclusive use test. This means you must use a specific area of your home, only for your trade or business. Chloe's spare bedroom? It can't also be the guest room where her parents sleep when they visit. It can't be the family playroom. It has to be a dedicated business space. The second is the principal place of business test. This means you must show that your home is the primary location where you conduct your business. For Chloe's graphic design side hustle, this is easy. It's the only place she works on it. Because Chloe's small side hustle meets these tests, she can now claim the home office deduction. And here is the earth-shattering secret. The deduction isn't just against her small side hustle income. The calculation is based on the home itself. This is how it works. Chloe has two ways to calculate this. The first is the simplified method. It's easy, clean, and rarely questioned by the IRS. She measures the square footage of her dedicated office space, up to a maximum of 300 square feet, and multiplies it by $5. If her office is 200 square feet, that's a simple $1,000 deduction. It's nice, it's easy, but it's often leaving a fortune on the table. This is where we get to the second method, the one that can save you thousands. It's called the actual expense method. And this is where your mortgage comes roaring back into the picture. Using this method, Chloe can deduct a percentage of her actual home expenses. The percentage is based on the size of her office relative to her entire house. Let's say her office is 200 square feet, and her entire house is 2,000 square feet. Her business use percentage is 10%. Now look at what she can deduct 10% of. It's not just her internet and electricity. It's the big stuff. The stuff we've been talking about this whole time. Her mortgage interest. Her property taxes. On top of that, she can deduct 10% of her homeowner's insurance, 10% of her utility bills, gas, electric, water, 10% of general home repairs, like a new roof or an HVAC repair that benefits the entire house. And she can even deduct depreciation on that 10% of her home's value. Let's run some hypothetical numbers. Suppose Chloe pays $15,000 in mortgage interest a year and $5,000 in property taxes. That's $20,000 right there. 10% of that is a $2,000 deduction. Let's say her utilities and insurance for the year are another $4,000. That's another $400. Let's say she had to pay for a $10,000 roof repair. That's another $1,000 deduction. We're already at $3,400, and we haven't even included depreciation, which could add another $1,000 or more. Suddenly, her deduction isn't $1,000, it's closer to $5,000. And here is the most important part of this entire strategy, the piece of information that elevates this from a good idea to a brilliant one. When Chloe, as a W-2 employee, takes the standard deduction, she gets no benefit from her mortgage interest or property taxes. But when she claims these expenses as part of her home office deduction for her side business, they are deducted on Schedule C, profit or loss from business. This is a business expense. It directly reduces her business income. This has two monumental consequences. First, it reduces her self-employment tax. That's the 15.3% tax for Social Security and Medicare that every self-employed person has to pay. A $5,000 deduction doesn't just save her income tax. It saves her an additional $765 in self-employment tax. It's a double dip on tax savings. Second, and this is the masterstroke, she can do this even if she takes the standard deduction. The home office deduction on Schedule C has nothing to do with itemizing on Schedule A. It is an above-the-line deduction. So Chloe can get the full, massive standard deduction, and she can separately write off a portion of her mortgage interest, property taxes, and other home costs as a business expense. She gets the best of both worlds. The very expenses she thought were lost to her because of the high standard deduction are now back on the table, saving her money in a completely different, and often more powerful way. This transforms a home from just a place to live into a hybrid asset. That small side hustle, the one making just a few $1,000s a year, becomes the legal gateway to converting a significant portion of her personal, non-deductible living expenses into legitimate, tax-deductible business expenses. The fine print didn't kill the deduction. It just created a new door. And the key to that door is having some form of business activity, no matter how small, that is run from your home. So if you're a W-2 employee working from home, feeling like you're getting a raw deal, the question to ask yourself isn't, can I take the home office deduction? The question is, can I start a small business from my home to qualify for the home office deduction? The answer for millions of Americans with a skill, a hobby, or a passion is a resounding yes. You are likely already sitting on the solution. But this deduction, while powerful, is based on ongoing expenses you pay every year. What about the money you paid only once on the very first day you closed on your house? There's a giant lump sum fee hidden in your closing documents that most homeowners assume is just a cost of doing business, a one-and-done expense. But the truth is, the IRS allows you to deduct this cost, not all at once but slowly over the entire life of your loan. It's a forgotten deduction that grows in power every single year, and almost nobody talks about how to claim it correctly. Unlocking it requires a trip back in time to the day you got your keys. Remember that moment? Sitting at a long polished table, a stack of paper an inch thick staring back at you. The title agent or lawyer slides document after document your way, pointing with a pen. Sign here. Initial here. Date here. Your hand starts to cramp, your mind starts to glaze over. You're just focused on the finish line, that set of shiny new keys. But buried deep within that mountain of paperwork, on a document you probably glanced at for 5 seconds, is the key to one of the most misunderstood and valuable mortgage deductions available: mortgage points. This document is your treasure map. It's likely called a closing disclosure, or if your loan is older, a settlement statement or HUD-1. Find that document. Dig it out of your files, because line by line it tells the story of how you bought your home, and more importantly, it tells the IRS exactly what you're allowed to deduct. We're looking for a specific section, usually on page 2 under loan costs. You'll see a line item that says points, with a dollar amount next to it. That number is pure gold. So what exactly are points? The simplest way to think about them is prepaid interest. Each point you buy typically costs 1% of your total loan amount. So, on a $400,000 loan, 1 point would cost you $4,000. In exchange for paying this fee upfront, the lender gives you a lower interest rate for the entire life of the loan. You're essentially buying a discount. And because points are just a form of mortgage interest, the IRS lets you deduct them. The billion-dollar question is, when? This is where 99% of homeowners get confused, and it's where you're about to get a massive advantage. You see, the IRS gives you 2 different ways to deduct your points, and the path you take depends on a series of simple tests. Path number 1 is the superhighway. It's where you get to deduct the entire cost of your points in the single year you paid them. If you paid $4,000 in points, you get a $4,000 deduction right away. This is obviously the best-case scenario, but to qualify, you have to pass the IRS's 7-part test. It sounds intimidating, but let's break it down. It's mostly common sense. First, your loan must be secured by your main home, your principal residence. This can't be a vacation home or a rental property. Easy enough. Second, paying points has to be an established business practice in your area. The IRS just wants to know this is a normal thing. If lenders in your town commonly charge points, you're good to go. You don't need to conduct a massive survey. If your lender offered them, it's almost certainly a standard practice. Third, the points you paid can't be more than what's usually charged in your area. Again, the IRS is looking for normalcy. You can't pay 10 points to get some crazy low rate and expect to deduct it all. As long as it's in the normal range, you're fine. Fourth, and this is a big one, you must use the cash method of accounting. Don't let the jargon scare you. If you're a regular person and not a major corporation, you use the cash method. It just means you report income when you actually receive it and expenses when you actually pay them. For 99.9% of us watching, check this box. Fifth, the points can't be for items that are usually listed separately on the settlement sheet, like appraisal fees, inspection fees, or property taxes. The points have to be purely for the cost of interest. Your closing disclosure will make this clear. If it's on the line labeled points, it's for interest. Sixth, and this is the most critical test of all, you must have paid for the points out of pocket. They can't be financed into the loan. The IRS wants to see that you brought your own money to the table to cover the cost. You might be thinking, how do I prove that? Go back to your settlement statement. Look at the total funds you were required to bring to closing. As long as the amount of cash you brought, your down payment, your closing costs, is at least as much as the cost of the points, you pass the test. For example, if you paid $4,000 in points and made a $20,000 down payment, you've clearly met the requirement. The IRS considers the first dollars you pay to be for the points. And finally, the 7th test. The points must be computed as a percentage of the principal amount of the mortgage, and the amount must be clearly shown on your settlement statement. Again, pull out that document. If you see a line that says points with a dollar amount, you've passed. If you can say yes to all 7 of these, congratulations. You can deduct every single penny you paid for those points in the year you closed on your home. If you closed 3 years ago and missed this, you can potentially go back and amend your tax return to claim it. That could be a check for hundreds or even thousands of dollars coming back to you. But what if you don't pass all 7 tests? What if, for instance, the seller paid for your points? Or what if you refinanced your home instead of buying a new one? Don't worry. You don't lose the deduction. You just have to take a different path, the scenic route. This is called amortization. Instead of taking the deduction all at once, you have to spread it out evenly over the life of your loan. Let's say you paid $3,000 in points on a new 30-year mortgage. A 30-year loan has 360 monthly payments. So you take your $3,000, divide it by 360 months, and you get $8.33 per month. You get to deduct that amount every month for the life of the loan. So for a full year, that's a $100 deduction. It might not sound like a lot, but that's $100 a year every single year for 30 years. That's $3,000 in deductions you would have otherwise missed entirely. It's a slow burn, but it adds up to real money. This scenic route is especially important for anyone who has refinanced. This is a trap that snares so many homeowners. When you refinance, the IRS generally does not let you deduct the points all at once. Why? Because the money from the new loan wasn't used to buy, build, or improve your home. It was used to pay off your old loan. Therefore, you must amortize the points over the life of the new loan. There is one powerful exception, though. If you did a cash-out refinance and used a portion of that cash to specifically make improvements to your home, like remodeling the kitchen or adding a new bathroom, You can deduct the portion of the points related to that improvement money immediately. For example, if you refinance for $300,000 and $30,000 of that was cash out for a new deck, you can deduct 10% of your points in year 1. The other 90% would have to be amortized. It's a bit of math, but it's worth it. Now, what happens if you're on this slow burn amortization plan and you sell your house or refinance again before the loan is paid off? This is the best part. The IRS gives you a fantastic parting gift. In the year you sell the home or pay off the loan, you get to deduct the entire remaining balance of the undeducted points all at once. Imagine you had $3,000 in points you were amortizing. After 5 years, you've deducted $500. You still have $2,500 of deductions left. If you sell the house in year 6, you get to claim that entire $2,500 on that year's tax return. It's a final bonus for being a homeowner, a tax windfall that most people leave on the table because they either forgot they paid points or didn't know the rule. So your action item is simple. Find your closing documents. Find the line for points. See how much you paid. Then run through the 7 tests. If you pass, make sure you took that big deduction. If you didn't, or if you refinanced, calculate your yearly amortization amount and make sure you're claiming it every single year. This isn't just a one-time trick. It's a financial habit that pays you back for decades. This strategy is all about leveraging the structure of your debt. But what happens when your home is more than just a place you live? What if it's also the place where you earn your living? The rules of the game change completely. The IRS has a labyrinth of regulations specifically for people who work from home, and a recent seismic shift in tax law has convinced millions of people that the home office deduction is dead. They believe it's a red flag for an audit that's no longer worth the risk. But they are dangerously wrong. There's a new, smarter way to claim your home as a business asset. A way to turn your living room, your spare bedroom, even your garage into a powerful tax deduction machine. And the secret isn't in what you deduct, but in how you define your business. It's a fundamental shift in thinking. For years, we've been told the home office deduction is about carving out a small piece of your home and dedicating it exclusively to work. A corner of the basement, a spare bedroom. You measure the square footage, you track a portion of your utilities, and you hope the deduction is worth the headache and the audit risk. But that's thinking like an employee. It's time to start thinking like an owner. Like a CEO. Your business, whether it's an LLC, an S-Corp, or even a sole proprietorship you're formalizing, is a separate entity from you, the individual. And that business needs a place to conduct, well, business. It needs a place for quarterly board meetings, for annual strategic planning sessions, for client appreciation events, for filming content, for team offsites. Where does it hold these events? A hotel conference room? A sterile co-working space? Or what if it rented a professional, comfortable, and convenient space? What if it rented your home? This is where the game completely changes. We're moving beyond the simple home office and into the realm of legitimate business rentals. And the key that unlocks this entire strategy is a little known but incredibly powerful section of the tax code. Section 280AG, more famously known as the Augusta Rule. The name comes from Augusta, Georgia, home of the Masters golf tournament. Residents there would rent out their homes for a week for an enormous amount of money, and thanks to this rule, they wouldn't have to pay a single penny of federal income tax on that rental income. The rule is simple. If you rent out your personal residence for 14 days or less per year, you do not have to report that rental income to the IRS. It is 100% tax-free. Now, most people hear this and think about Airbnb or renting their house out for the Super Bowl. But the true power players, the savviest business owners, saw something else. They realized the rule doesn't specify who you have to rent it to. So here's the play. You, the homeowner, rent your house to your business for legitimate business purposes. Let's say you have an S-corporation. Your S-corp needs to hold a mandatory annual shareholder meeting. Instead of renting a hotel ballroom, your S-corp pays you, the individual, a fair market rate to rent your home for the day to host the meeting. Let's break down the magic of what just happened. First, your business, the S-corp, just generated a legitimate business expense. It paid for a meeting venue. That rental payment is now a tax deduction for the business, lowering its taxable profit. Second, you, the individual homeowner, just received that rental payment. And because you rented your home for only 1 day, far less than the 14-day limit, that income is completely and totally tax-free to you. You've effectively moved money from your business pocket, where it would have been taxed, to your personal pocket, where it is not taxed. It's a perfect transfer of wealth sanctioned by the IRS. This isn't a shady loophole. It's a specific provision in the tax code designed for this exact purpose. Let's make this real. Imagine you're a consultant. You decide your LLC needs to hold a quarterly strategy session to review financials and plan for the next quarter. That's 4 meetings a year. You also decide to host a 2-day client appreciation dinner and workshop at your home. That's another 2 days. And you need a full day to film a new series of marketing videos. We're now at 7 days for the year, well under the 14-day limit. Now the critical part, fair market value. You can't just pull a number out of thin air. The IRS requires the rent to be reasonable, so you do your homework. You check what a local hotel conference room costs, what a daily office rental goes for, or what event spaces in your area charge. You find that a comparable space for a full-day meeting with amenities costs, say $600. So, for each of those 7 days, your LLC writes you, the individual, a check for $600. At the end of the year, your business has a legitimate $4,200 tax deduction for meeting and event space rental. And you, the individual, have an extra $4,200 in your personal bank account, completely tax-free. If you're in a combined 30% tax bracket, that's a tax savings of over $1,200 for the business, plus you personally received $4,200 of tax-free cash. The beauty of this is its flexibility. It doesn't require the exclusive and regular use test that the traditional home office deduction does. You don't need a dedicated room used for nothing else. You're renting your entire living room, your dining room, your backyard patio for a specific, documented business purpose on a specific day. Now, before you rush off to do this, hear me loud and clear. Documentation is your best friend. The IRS is not a fan of ambiguity. To make this strategy bulletproof, you must treat it like a formal business transaction. First, you need a rental agreement between you, the landlord, and your business, the tenant, for each rental day. Second, you need to document the business purpose. Have meeting agendas. Keep minutes of what was discussed. If it's a client event, keep the invitation list. If you're filming, have a production schedule. Take pictures of the meeting or event in progress in your home. Third, your business must actually issue payment to you. A bank transfer, a check. Create a paper trail. Finally, keep proof of how you determine the fair market rent. Screenshots of competitor pricing. Emails with quotes from local venues. With that documentation in place, you've just turned your home into a tax-advantaged asset for your business, without the strict limitations of the old-school home office deduction. You're not just deducting a fraction of your utilities anymore. You are generating a direct business expense deduction and creating tax-free personal income simultaneously. This is a paradigm shift. Stop thinking about how to shave a few percentage points off your light bill. Start thinking about how your business can leverage its biggest asset, your home. You can use this for team-building events, holiday parties, focus work sessions to finish a big project. Any legitimate business activity that would otherwise require renting an outside space can now be held at your home, creating this powerful tax benefit. And here's a pro tip. This strategy can be used in addition to the standard home office deduction. If you have a dedicated home office that meets the exclusive and regular use test, you can still take that deduction for the business use portion of your home's ongoing expenses. Then you can also use the Augusta rule to rent out the other parts of your home, the dining room, the patio, the living room, to your business for those specific event days. They are not mutually exclusive. This is how you start to layer tax strategies. It's about understanding that your home isn't just a place to live. It's a potential portfolio of assets. Your spare room is an office. Your living room is a conference center. Your backyard is an event venue, each with its own unique way to serve your business and lower your tax bill. We've just unlocked a method to create thousands in tax-free income and business deductions. It's powerful, it's legal, and it's hiding in plain sight. But this is still just one piece of the puzzle. We've been talking about deducting interest, points, and even renting our home to ourselves. But what if we could go bigger? What if you could structure things in such a way that you could, over time, strategically and legally write off the cost of the entire house itself? Not just the interest, but the principal, the building, everything. This isn't a fantasy. It's an advanced structuring technique that combines the corporate entity with real estate depreciation in a way most homeowners never even know is possible. In our final part, we are going to explore the ultimate homeowner tax strategy, the one that lets you treat your personal residence like a commercial investment property, unlocking a level of deductions that can completely transform your financial future. This is the final boss of mortgage tax deductions, and you do not want to miss it. It's officially known as Section 280AG, of the Internal Revenue Code, but it has a much cooler nickname, the Augusta Rule. And the story behind it is exactly why it's so powerful. The name comes from Augusta, Georgia, home of the legendary Masters golf tournament. Every year, wealthy residents would rent out their mansions for exorbitant sums to corporations and high rollers for the week of the tournament. To give these locals a break, a special provision was created. If you rent out your personal residence for 14 or fewer days per year, you do not have to report any of that rental income to the IRS. It is 100% tax-free money. Now you might be thinking, that's great for someone who lives near the Super Bowl, but I live in a regular suburb. Who's going to rent my house? And that is the wrong question. The right question is, how can I create a reason for my house to be rented? The answer is the master key to this strategy. If you own a business, an S-Corp, a C-Corp, an LLC, or even a sole proprietorship, your business can rent your home from you. Let that sink in. You, the individual homeowner, rent your property to your business for a legitimate business purpose. The business pays you fair market value for the rental. That payment is a deductible business expense, which lowers your business's taxable income. And you, the individual, receive that payment completely tax-free, thanks to the Augusta Rule. You are literally shifting money from a high-tax business environment directly into your personal pocket with zero tax liability. It is the cleanest, most direct way to pull profits from your company without paying a single dime in taxes on it. Let's make this real. Imagine you're a consultant operating as an S-Corp. You need a place to hold your quarterly board meetings, your annual strategic planning session, and maybe a holiday party for your team or top clients. Instead of renting a sterile conference room at a hotel for $1,000 a day, your business rents your home. You hold a 2-day board meeting at your house every quarter. That's 8 days. You hold a 2-day annual planning session. That's 10 days. You host a client appreciation event. That's 11 days. You are well under the 14-day limit. Now, what's the fair market value? This is the critical part. You can't just invent a number. You have to be able to prove it. So you do your homework. You go on websites like Peerspace or even Airbnb and see what similar homes or event spaces in your area rent for on a daily basis for corporate meetings or small events. You might find that a home like yours, with its nice living room, backyard patio, and full kitchen, could easily command $500, $600, or even $800 per day. You print out these comparisons, you save the screenshots. This is your proof. Let's be conservative and say you establish a fair market rate of $500 per day. For those 11 days of legitimate business use, your S-Corp pays you, the homeowner, a check for $5,500. What happens on your taxes? Your business gets to write off the full $5,500 as a legitimate rental expense, saving you money on your business taxes. And you deposit that $5,500 check into your personal bank account, and on your Form 1040 personal tax return, you report nothing. Zero. It is phantom income to the IRS. You just paid yourself $5,500 tax-free. If you're in a combined 30% or 40% tax bracket, that's like giving yourself a bonus of over $7,500 or $8,000. This is not some theoretical loophole. This is a specific provision written into the tax code. But it comes with very sharp teeth, and if you get this wrong, the consequences are severe. So listen closely. There are 3 non-negotiable rules you must follow. Rule number 1. The business use must be absolutely legitimate and ordinary. You can't claim you rented your house for a corporate meeting. That was just you watching Netflix on the couch. We're talking about actual documented meetings. You should have meeting minutes. You should have an agenda. You should have a list of attendees. If you host a client event, you should have the invitation list. You need to create a paper trail that proves, without a shadow of a doubt, that real business activity occurred. Rule number 2. The price must be fair market value. This is where people get greedy and get caught. If you try to charge your business $5,000 a day for your 3-bedroom ranch house in a suburb where the going rate is $400, the IRS will tear that deduction apart during an audit. They will disallow the entire expense, and you'll be hit with back taxes, penalties, and interest. Do your research. Document it. Be reasonable. It is far better to get a legitimate, defensible $5,500 tax-free than to get a fraudulent $50,000 deduction thrown out. And rule number 3, the most important rule of all. Do not go over 14 days. Not even by 1 hour. The moment you rent your home for a 15th day, the magic disappears. The Augusta Rule no longer applies. Now, all the rental income for the entire year becomes taxable. You have to report it on a Schedule E, depreciate your property, and deal with all the complexities of being a landlord. The 14-day limit is a cliff, not a slope. Stay under it, no exceptions. The Augusta Rule is the perfect capstone to our journey through mortgage tax deductions because it embodies the central theme. Your home is not just a place to live. It is a dynamic financial tool. We started with the basics, the mortgage interest deduction that nearly everyone knows about. We moved to the more nuanced strategies like deducting points, understanding helix, and fighting for your PMI deduction. We uncovered the hidden value in property taxes and the home office deduction. But the Augusta Rule? It elevates the conversation. It forces you to stop thinking like a mere homeowner and start thinking like an investor, like a CEO of your own life. It's about seeing the assets you already have, your home, your business, and finding the legal, ethical, and strategic intersections between them that the tax code explicitly allows. The wealthy don't get rich by earning more. They get rich by keeping more of what they earn. They do this by understanding the rulebook. The tax code isn't a punishment. It's a set of incentives. It incentivizes homeownership. It incentivizes business creation. And when you do both, it offers incredible rewards for those who take the time to learn the rules. Now I have to say this, and it is the most important piece of advice in this entire video. I am not a CPA, and this is not personalized tax advice. This is financial education, designed to open your eyes to what is possible. The single greatest investment you can make after watching this is not in a stock or a piece of real estate, but in a conversation with a qualified tax professional. And I don't mean a data entry person at a seasonal tax shop. I mean a proactive tax strategist, a CPA who works with other business owners and real estate investors. Find someone you can sit down with in July or October, not just in April. Someone to whom you can say, I learned about the Augusta Rule, Section 280 AG. Does this make sense for my business? How do we document it properly? What other strategies am I missing? That single conversation could save you tens of thousands of dollars over your lifetime. You have now been armed with a complete arsenal of knowledge, from the foundational to the expert level. You understand that your mortgage is more than a debt. It's a source of powerful deductions. You know that the tax forms you file are not just a summary of the past, but a reflection of the financial strategy you've implemented all year long. The power is now in your hands. It's the difference between passively letting taxes happen to you and actively making the tax code work for you. It's the difference between just owning a home and truly leveraging it as the cornerstone of your financial freedom. Thank you for staying with me to the very end. Your attention is the most valuable thing you have, and I hope I've rewarded it. If you found even one piece of information in this video that could save you money or change the way you think about your home, do me a favor and hit that subscribe button. We're on a mission to bring this kind of high-level financial strategy to everyone, and by joining our community, you become part of that mission. And finally, to help everyone learn from each other, drop a comment below and tell me, what was the single most surprising deduction you learned about today? Let's see what resonated most. Thank you for watching and start planning.